All right, day 2 of boot camp. We are going to be discussing and going over the trade plan, okay? No fluff, only what you need, the things that you need to concentrate on, the things that you can control. We laid down the foundations of where to enter the market, where we should exit the market. We went over kind of the technical side and the strategy side of trading yesterday. Now it's time to bring those things together and put them into a plan. Okay. Everybody trades different. Some of you all trade different markets. Some of you all like to scalp. Some of you all like the intraday trade, swing trade, etc. Right. But the methodology and the philosophy is the same no matter what type of trader that you are. Okay. And it's imperative that you're able to put those elements of trading together in a sound trading plan and make it your own. Okay. Now, uh, first things first. Okay, let's talk about the trading uh, checklist. Okay, everybody has their notebooks. Okay, all right, good. So our trading checklist. Okay, trading checklist. Okay, the first thing, the first thing that we need to go over is the process. Okay, so the very first thing that you should have in your trading journal. Okay, if you're a scalper, you're looking at the 30-minute and the 15-minute liquidity levels. Okay, so the scalpers, those of you who just like to make 2, 3, 4 points at a time or per trade. Okay. You need to have your 30-minute and 15-minute major liquidity targets outlined in your trading journal and your trading plan. Okay. The intraday traders. Okay. I'm an intraday trader. I like to look for the larger move of the day when I trade. Okay. I'm looking at my daily, my 4 hour, and my 1 hour major liquidity levels. Okay. So scalpers, 30 minutes and 15-minute major liquidity levels, intraday traders, daily 4 hour and 1 hour major liquidity levels. Okay. These are our targets in the market. These are our exits in the market. Okay. And before you come to the market, okay, the next thing that you need to have are your points of interest. Okay. Your points of interest are going to consist of your highly concentrated manipulation zones and your Catla X3 zones. Okay. These are going to be your highly concentrated areas of manipulation, and these are going to be the only places that you're looking to execute a trade from. Okay, these are going to be the only places that you're looking to execute a trade from. I'm going to challenge everybody in this boot camp that nobody needs to be, even if you're a scalper. Okay, nobody should be taking more than two to three trades a day. Okay, over the next month of the trade room, um, this is the plan that we're going to adhere to. I'm going to adhere to this plan with you side by side in the live trading sessions. Okay. No more than 2 to 3 trades per day. We're only taking trades based off of what our highly manipulated zones and our Catla X zones. Okay. Now for your scalpers, okay, the scalpers, you only need to mark your highly manipulated zones for the 1 hour and the 30-minute time frames. Okay, scalpers, 1 hour and 30-minute time frames. Intraday traders, your highly manipulated zones will come from your daily, your 4 hour, and your 1 hour time frames. All right, we all on the same. Oh, same. So the scalpers, your highly manipulated zones will come from your 1 hour and 30-minute time frame. So your order blocks plus your FUs. Intraday traders, your highly manipulated zones will come from your 1 hour, 4 hour, in daily order block plus FUs. Okay, and obviously your Catla X 3 zones as well. Okay, now another thing that I like to do, right? We talk about the Catla X 3 zones. Our execution time frames are typically what? Our 1 minute to 5 minute time frames. Okay, so what I often do is on my 1 hour or 30-minute time frames, I'll also box out my Catla X 3 zones so they show up on my execution time frames as well. Does that make sense? Yep. So for example, let me go to the chart, right? I'm looking at my 5 minute time frame here, right? What I often do is I'll go to, like, for example, I'm looking at my 1 hour time frame here, right? What I often do is go and mark out this zone. 30-minute time frame is a little smaller, so I can refine it. Yes, you can. Yes, it is fine that you can extend it past where it stops. So I like to look at the 1 hour in lower Catla X 3 zones, right? So that way when I can concentrate on my I can concentrate on my execution time frame. So now when I zoom down to my 5 minute time frame, right? I got a Catla X zone right from my 1 hour and 30 minute, and I got a Catla X zone right here from my 15-minute time frame. Okay, does that make sense? Okay, so I'm marking out my order blocks plus FUs, right? And then I'll also mark out and refine my Catla X3 zones, right? On the time frames right above my execution time frames. Okay, because these are high areas of what previous manipulation. These are highly concentrated areas of previous manipulation. All right. So now, uh, no, nope, they're not. All right. So now, let's talk about trade execution, right? How many of you all second guess yourself when you are, when it's time to actually put on a trade? Should I put on a trade? Should I put should I not put on a trade? Is this a valid trade, etc.? Okay. Everybody goes through it at some point or another. Okay. Let's we're gonna make a general rule of thumb here. Okay. And this is something that I've been cognizant of over the years, and something that I'm very intentional and aware about. When I have a trading opportunity, or if I'm sitting in front of my laptop, right, or my trading computer, if I'm having a hard time getting a read on the market, then I don't take the trade. Okay. Or I shouldn't take the trade most of the time. They'll still take the trade sometimes. Absolutely. Okay. Your goal is to take the highest probability trading opportunities. Okay. And you want to execute the trades that are clear. Okay. If I get to a place, or the market gets to a place of indecision where I'm like, man, this could possibly go long from this point, or it can possibly go short from this point. Okay. If my brain is having that conversation with itself, okay, this is a sign. This is one of the things that I write down, and I take note of my trading journal, that I do not need to be taking this trade. Okay. Everybody understands what an order block and an FU is. Everybody understands. We walk through the strengths of the FUs. Everybody understands the rejection, okay, or manipulation from our points of interest, okay. And these things should be clear, okay. And if they're not clear to you, then it is a good sign that you probably should wait and sit out of the trade. Are we all on the same page there? All right, good. Okay. The more precise, and this is the importance of a trading plan as well, the more precise that you can become, the more meticulous you can become about taking only the best quality trades and the best quality setups, the better your trading performance is going to be. Okay. And this doesn't equate to um, paralysis through analysis, over analyzing it or overthinking it. Right. I want the market to be trading at a clear point of interest that I've already defined. And I want to see manipulation in the direction that I want to trade from that point. Okay. Write that down. I want to see the market trading at a point of interest that I've already predefined. Okay. And I want to see manipulation in the direction I want to trade from that point. Understood? All right, good. Now, when it's time to take it, when it's time to take a trade, I am going to give you I'm gonna give you the checklist. Okay. When it's time to take a trade, first thing that needs to be spotted, first thing that needs to be understood, first thing that needs to be outlined is, do I have liquidity to target? Okay. What is my exit? What is my goal? What is my endpoint? Where am I expecting this market to travel to? Okay. The second thing is understanding, where is my true stop loss. Number three is, has manipulation occurred? Number five, number four is, have I identified my last area of liquidity? Have I identified my last area of liquidity? And the last thing is, do I have a trade confirmation? What is my trigger? Okay. When you act in the market, you need to have a specific trigger, okay, that you can lean on. Okay. What is my trigger? What gave me to go ahead that said now is the time to push the button? Okay. Most people have a hard time pushing the button because they don't have a trigger, right, to let them know when to push the button. Okay. Everybody with me thus far? All right, good. Okay. Now let's talk about trade confirmations or trade triggers. Okay. Number one being a trade trigger is retest of manipulation. Number two is manipulation forming in real time. Okay. Meaning that you're watching the market, it's trading at an area of interest for you, and all of a sudden we form a FU from that point or in that area. Number three is taking of the last area of liquidity. And no, there is no specific order. Okay. I'm giving you 5 different trade triggers. Okay. You find the one that is easiest for you to read. Is no one is more important than the other, right? But it's important to know what is your trade trigger, what is going to trigger you to get in a trade, right? Because the purpose of a trigger is something that say, hey, based on my analysis, based on my things that I've already predefined, once I see this occur, this gives me confidence to execute. Number three was the last area of liquidity being taken. And and number four, one of my favorites that I love to lean on is the options order flow. Okay. Tonight I'm gonna go over how to pick the relevant options. Okay. I'm gonna go over how to pick the relevant options for those who like to trade the ES, and how to pick the appropriate options. And then once we get into the trade room, I'll be diving into that at on a much deeper level. Okay. Everybody got the trade triggers written down. Okay. Brian said, is the target normally 1 to 4 at a time? No, the target isn't necessarily 1 to 4. The target, it doesn't matter if it's 15-minute liquidity target, a 60-minute liquidity target, a 4-hour daily, etc. Okay. This is all about where liquidity resides and whether you're looking to scalp for a couple points or you're looking to swing trade. No, it's not 1/4 of the time frame. Okay. And we always, okay, and we always want to have a trade with at least a 1 to 3 risk to reward ratio. Okay. We should always have a trade. Our trade should always at least be a 1 to 3 risk to reward ratio. If you don't have a 1 to 3 risk to reward ratio uh, opportunity, then guess what? You don't have a trade. And in my last trade trigger that is again specific to trading the S&P 500 is the comparison of the S&P 500 to the NASDAQ, to the NQ. Okay. The NQ typically leads the S&P 500. Okay. So I know it's a lot of NQ traders in here. It's also a lot of S&P traders here as well. So comparing the price movement of the NQ to the S&P 500 can also serve as a trade trigger for you. Okay, we're all on the same page there. All right, good. So let's take a look at let's break down example of the actual money aspect, right? I know a lot of you are passing or looking at past prop firm evaluations and challenges and different things of that nature. Okay. And it's a mathematical way that this should be approached. Okay. So let's kind of go through let's go through an example. Okay. And this is a process that you should be going through on every single trade. Okay. This is a process that you should be going through on every single trade. Okay. According to my checklist, what is the first thing that I need to have in mind when I put on a trade? Okay. Liquidity, right? Do I have liquidity to target, right? So in this example here, okay, because we marked out this level yesterday during boot camp, okay, we're gonna be targeting, right? And I want you all to write this down as I go through it. We're gonna be targeting 21.95. Okay, we're gonna be targeting 21.95. Okay. Now, I think for the if you're doing $100,000 evaluation account, I think the typical drawdown is what, 2,500 bucks. Okay. Okay. Got a $2,500 drawdown. Okay. Now, when I first started doing the evaluations, I started, especially because different prop firms, different situations, I mean, different brokers had different drawdown, trailing drawdown rules, etc. Right. So I always broke this down into 10 trades. Okay. Meaning that what I would need to have 10 losers in a row in order to blow my account. Okay, roughly 10 losers in a row. Okay, so even those of you who only been trading for a couple weeks or a couple months and know how to maneuver the charts, everybody here has experienced a winning trade, correct? Right. And I also dare to say it probably not too many of you have ever experienced 10 losing day trades in a row. Okay. Sticking to the strategy, sticking to the methodology, okay, is very difficult, okay, and highly unlikely that you're going to have 10 consecutive losing trades. Okay. Highly unlikely. Okay. The only ones who may come close to that are who the scalpers. Okay. The scalpers are inherently going to take more losses than your intraday traders. Okay. But even the scalpers that's executing based on this methodology and strategy should have a hard time losing 10 consecutive day trades in a row. Okay. Now, if my trailer drawdown, if my drawdown is 2,500 bucks and I'm going by the 10 trade rule, how much can I risk per trade? $250. Okay. Now we're looking. This example is coming on gold, right? How many points per tick is gold worth? One tick equals $10. Okay. So if I was trading, okay, if I was trading just one contract, okay, how many ticks could my stop loss be? What's the maximum number of ticks could my stop loss be? 25. Okay. So now we got a target of 21.95. Okay. We got a target of 21.95. Okay. And let's say and we look to, in this example, we look to enter after the news, right? We had a news announcement here at 2 o'clock. Okay. We had a volatility candle. Okay. And we were interested in taking a trade somewhere, uh, based off of this volatility move. Okay. So let's say our entry, and we had a high area, I mean highly concentrated area of manipulation here at 2174.6. Okay. So trader number one, okay, trader number one entry was at 2476. And trader number two entry was 2183 after manipulation here. Okay. Now trader number one had an entry of 2176. Zoom down to the 1 minute time frame. All right. So if trader number one entered at 2176, okay, if trader number one entered at 2176, where is the true stop loss? Where would the true stop loss be for this particular trade? Yeah, below the FU at 21 uh roughly 2174.8. Okay. How many ticks is that? Entry at 21.2176. True stop loss is 2174.8. How many ticks is this? Yep, it's 12 ticks. It's 1.2 points, which equals 12 ticks. Okay. So how many? So the next question, okay, the next thing that you have to understand is how many contracts can trader number one trade? Yes, two contracts, right? And if trader one trades two contracts, what is their maximum risk? 240 bucks. Okay. Now from 2176 to 2195, how many ticks is this? 2176 to 2195. It's 19 points, right? But it's what? 190 ticks. Okay. 19 points and 190 ticks. Okay. So to get my risk to reward ratio, I need to divide 190 by 12. What is my risk to reward ratio? Yep, 15.8. Okay, 15.8. Okay. Is this risk to reward ratio greater than 1 to 3? Okay, good. All right. So 190 ticks. Okay. 190 ticks times two contracts equals how much? How much money would you have made on this trade trading two contracts if you would have held to 21.95? Yep, 3,800 bucks. Okay, 3,800 bucks. Now let's take a look at trader number two. What did I say his entry was? 21, 2183. Okay. So 2183 is trader number two. All right, so roughly right here. Okay. 2183. Now trader number two who decided to enter the market at 2183, where would their true stop loss be? Okay. Where would trader number two true stop loss be? Okay. If they entered the market here, okay, where would the true stop loss be? Good, good, Kiera. Both Kieras, right? The true stop loss would be where below the last area of manipulation. Okay. This is the true stop loss. Okay. Now let's see if trader number two should have even been taking a trade in the first place. The difference between 2183 and 2176. Okay. That's 7 points or what? 70 ticks. Okay. Should trader number two been taking a trade in the first place? Nope, absolutely not. Okay. But okay, let's just say trader number two took the trade anyway. Okay. How many contracts could trader number two put on? Come on, say that's probably me. Okay. But listen, this is how exact you have to be about this. Okay. At the most, trader number one could only trade one contract. I mean, trader number two could only trade one contract. Okay. Now, trader number two has a 70 tick stop loss. Okay. And let's just say trader number two took the trade because of what? The 5 minute FU that occurred. The market came back and made this 5 minute FU. Okay. Yeah, they shouldn't have been taking the trade in the first place, right? But I'm going through this as an example to show you the difference. Okay. They seen this 5 minute FU after the market push higher. So they said, hey, I'm going to take this trade. All right. 2183, the true stop loss was down here at 2177. Okay. 70 ticks. Okay. Now from 2183, they're still targeting 2195. Okay. So from 2183 to 2195, how many points is that? 12 points or 120 ticks. Okay. What is the risk to reward ratio for trader number two? Right? It's not even a 1 to 2 risk to reward ratio. Okay. It's a what 1 to 1.7 risk to reward ratio. Okay. But again, I'm going through this example because guess what? I'm sure 99% of you all on this webinar can relate to taking this type of trade at some point or another. If you have, give me a one in the chat box. If this has been you at some point in your trading career, give me a one. Okay, good. Now, the trade end up working out, right? And I used to, and my brother's sitting up here with me now, and I used to drill this into him during COVID. The worst thing that can happen for a trader, okay, is for you to do the wrong thing and it work out. Okay. And it works out. Okay. The worst thing that you can do is to do the wrong thing and it work out in your favor. Because wow, when it happens again, you just say, hell, it worked last time, it should work again this time, right? But this is a sure way to do what? Blow your account. Okay. This is a surefire way to eventually blow up your trading account. Okay. Now, Jasmine said that's me when I scalp. Okay. And listen, the scalpers, you know, you definitely have to be very meticulous about your trading, and scalpers especially have to pay attention to the last areas of liquidity. Okay. So on trader two, how much money did trader two made. $1,200. Okay, $1,200. We had the same target. Okay, but what our initial risk was very different. Okay, same target, initial risk was very different. Now let's go back to the trader number one who got in at 21. What's the entry of trader number one? 20. Yeah, 21.76. All right, trader number one got in at 21.76. All right, so let's go to trader number three. Okay, still got a 21.95 target. All right, trader number three. Okay, trader number three decided to get in after the retest. Okay, after the retest of manipulation. Okay, the market retested manipulation and closed at say 21.79. They entered at 21.79. Okay, where is the true stop for trader number three? Where's the true stop loss for trader number three? Yes, below. Good. True stop loss for trader number three is below this FU right here, the FU that they enter, right? Because the market came down, retested this FU, okay, and it held and formed what, another FU to the upside. Okay. Now their entry was 21, their entry was 21.79. Their stop loss, let's just say, was 21.76. Okay, how many ticks is this? 30 ticks. Okay, still a bit more than we should be putting on. Okay, now how many contracts can trader number three take? Only one. Okay, only one. Okay, still roughly in the same area that what trader number one decided to take, right? Still roughly not too far off when we look at the chart. Okay, so we got 30 ticks of risk. Now what's the difference between 21.95 and 21.79? Yep, 16 points or 160 ticks. Okay, so how many times does 30 go into 160? Yep, 5.3. Okay, so now they're still targeting 21.95. Okay, the trade works out in his favor. The trade works out in traders number three favor as well. How much money does trader number three make? $1,600. Okay, $1,600. Now, just from this example alone, okay, this should open your eyes up to the importance of being precise about your entries and your risk. Okay, trader number one made $3,800. Trader number two made what, $1,200, right? And trader number three made $1,600. Okay, on the same move. Okay, but what was different? The entry and what, the risk. Okay, so when I'm working on becoming a better trader, okay, this does not equate to me wanting to be right more often. Okay, I get questions all the time, DMs, etc. Right? Everybody want to get better at trading, right? But what most of you are asking me is, how can I be right more? Okay, and to be honest with you, I don't have an answer to how to be right more, because what being right or being correct is outside of our control. Okay, we on the same page there. Okay, so when I'm diving into becoming a better trader, when I'm working on my craft, my skill set, right? What I'm working on is, how can I be more precise with my risk management? Okay, the difference between my ability to see these FUs, manipulation, these highly concentrated area zones, right, and my ability to profit from them are different, not because of anything else outside of what how I manage my risk. Okay, this is a process. If you want to be a consistently profitable trader, this is a process that you literally have to fall in love with. Okay, this is the only path to improving your trading, and this is the only path to increasing your profitability in the market. I don't have any other answers for you as to how you can be right more in the market. Okay, if you want to become a better trader, the only thing that you can do is do what? Work on and improve the things that you can control, primarily your risk. Okay, my intentions over the next month of us partaking in the trade room together is us being very meticulous and becoming very granular about what, managing our risk. Okay, we all on the same page there. All right, so now let's go back to our, let's go back to trader number one who entered the market um at roughly this point here. Okay, I'm put an E for entry there. Okay, so we had liquidity to target at 21.95. We understood where our true stop loss was. Okay, um we had manipulation to occur in the market. Okay, now if I was executing on my 1 minute time frame, okay, if I was executing on my 1 minute time frame, it's important for me to know where is my last area of relevant liquidity. Okay, so if I enter from here, okay, where's my last area of liquidity? If this point here was my entry, where's my last area of relevant liquidity? My last area of relevant liquidity would be this imbalance right here. Okay. And I also have what? An area of liquidity here. And I also have a imbalance here. Everybody see that? We're on the same page. All right. So question. If I have a imbalance here, if I have a doji here, and if I have an imbalance here, okay, according to our methodology, according to our strategy, okay, what is the earliest point in which we could have even considered a long trade? No, if Jonathan, if it has a wick, it's not an imbalance. Okay, imbalances are candles with no wicks. Good, Kiera. Good, John. Good. Okay. This is our first. If you're sticking to the strategy, this is our first opportunity at an entry. Okay. This is our first opportunity as an entry. Why is this our first opportunity as an entry? Kiera, good. Okay. A FU after what liquidity has been left behind is letting us know, okay, that the market is okay with leaving this liquidity behind because it is in search of liquidity higher. Okay. We moving higher, but we left behind what? Relevant areas of liquidity, or our last areas of liquidity, in the form of what? Imbalances, dojis, and another imbalance. And then the market did what? Came back and gave us an FU in the direction that we want to trade. Okay. So when this occurred, it let us know that it was okay for the time being to leave these liquidity areas behind. Okay. If that makes sense, give me one in the chat box. Okay. Once we got, and we're looking at the 1 minute time frame. Once we got a manipulation to the upside, okay, it let us know that what? It was okay with leaving these areas of liquidity behind. John, the market can do anything at any given time. It absolutely could have done it. No question. Okay. But again, we don't have a crystal ball to see what's going to happen next, right? Hindsight is always 2020, and understand it's always at the front of your mind, not the back of your mind. Understand that the market can do anything that it wants at any given time. Okay. Now, this is our first opportunity to trade. Okay. Now let's be realistic, right? And talk about how things would have shaped up in real time. Okay. What would have been our second opportunity to take a trade? Nope. Nope. Everybody on here lying. Everybody is on here lying, right? Now, this is a prime example, okay, of our brains working in a way that we only want to see what we want to see. Okay. And this is the importance of going back and back testing it as well. No, there is a second and a third opportunity. Okay. But guess what? Because we already know that the market went to 21.95, we can already see, right? And this is something that you all have to become aware of. Our brain has a way of doing what? Seeing what we want to see. Okay. This is why it's meticulous to be, it is important to be meticulous about your journaling and tracking this. Okay. This is our second trading opportunity right here. But nobody on the webinar seen it. Why didn't anybody see it? Huh? Nobody's seen it because this was a what? This would have turned out to be a losing trade. Okay. Nobody's seen it because why? It turned out to be a losing trade. But this is the type of stuff that happens and unfolds in real time. Okay. There would have been no reason if we were just analyzing the 1 minute time frame, there would have been no reason for us not to take this FU to the upside. And let me just scoot the chart over just so you can see. Okay. There would have been no reason for us not to take this trade. Okay. Because why? We had a FU to the downside. Okay. We had a FU to the downside. Yes, we had an imbalance, but we had what? Our initial FU to the upside that gave us our first trading opportunity. Okay. So if you were thinking correctly, okay, you would have absolutely taken this trade. This is a trade that I would have taken. Okay. Yes, again, this is a trade that I would have taken. Why would I have taken this trade? Because I'm already expecting the market to go long. I already have an FU to the upside, right? I already have a what? Volatility candle, right? And this third candle did what? It closed above what? The close of the volatility candle. Okay. And then what? We had an FU to the downside, and the market came back and formed what? A FU to the upside. Okay. I'm immediately thinking, yes, we are going to continue higher. Okay. Uh, a FU negation. We negated the FU to the downside and formed what? A FU to the upside. Okay. My thinking is that what? It was okay with leaving this doji liquidity behind and this imbalance behind. Okay. Yes, Kiera said it best. This is a prime example of the market doing whatever it wants to do. Even when you have the proper analysis, even when you had a proper strategy and a proper methodology behind taking it, guess what? You're still going to have some losing trades. Okay. And when you're back testing, these are things that you have to take into account. Okay. Not one person, even if you saw it, not one person was brave enough to type into the chat that this was the second trading opportunity. Okay. Now, what was our third trading opportunity here? Yep, the retest. Okay. Which was what? a high confirmation setup. Okay, high confirmation setup. And ultimately, this was the move that eventually took us to what? 21.95. Okay. Now, when you're journaling and you're going through this process, how many of you would have been brave enough after taking a stop loss, right? Brave enough to do what? Give it another shot. Okay. And guess what? Everybody here, everybody in the sound of my voice should have absolutely given it another shot. Why? Yeah, risk to reward, but also what this signal is what? What is it? What is this signal here? It's a high confirmation setup, right? And what do we know about our high confirmation setups? It is the strongest form of manipulation. Okay. It is the strongest form of manipulation. Okay. When the high confirmation setups occur in our relevant areas, I take them every single time because this is our absolutely strongest form of manipulation in the market. All right. We all on the same page there? All right. So let me dive into the John say, well, we left liquidity behind initially with the first FU. Will we not want to try to nab the imbalance liquidity first and then manipulation, as in it not always knowing to take out liquidity first? No. Okay. No. If you get manipulation, okay, rule of thumb. Let's not overthink it. Rule of thumb. If you get manipulation, okay, and there's liquidity still left behind, okay, the market is telling us that yes, it is okay for this liquidity to be left behind. Okay. This FU here already gave us the indication that this liquidity was okay with being left behind. Okay. The market was already okay with it with this price action here. Okay. So when the market came back and formed another FU to the upside, okay, on this initial FU that already let us know that this liquidity was okay with being left behind. No, this is a time to press go. Okay, we're not looking to target that liquidity. Okay, this is even a stronger sign. The fact that we retested the manipulation that told us that hey, this liquidity below us it was okay for it to be left behind for now. Does that make sense? Good. All right, let me pull up my. All right, I want to go over. I want to go over the options trade confirmation. Okay, and I'm literally just going to go over how to select the options. Once we start getting into the trade room, um, I'll go over in real time how we analyze them. Right, I'm going to give you the basis and the foundation tonight, but this is something that we're going to dive into in real time. Right, but I also want you all to know how to go about choosing your options to use the options as a trade confirmation. Okay, so understand this: the options lead the underlying market. Okay, the options lead the underlying market. The options lead. Anybody know why does the options lead the underlying market? Anybody got a guess? Yep, hedge, act as insurance, protection. Yes, absolutely. Okay. So what I look for, and I want you to write this down. Okay. If you trade the S&P 500 and you're using the options as a trade trigger, this is my top trade trigger that I lean on or rely on when I'm trading the S&P futures. Okay. I want to choose an option that has the same day expiration. Okay. And I'm looking at the SPX weekly options. I want the same day expiration. I want an expiration 1 week out. And I want an expiration that's 30 days out. Everybody got that? Okay. So now we know that what we use options at that the banks and the institutions use options as protection. Okay. And I want you to follow me here, right? Let your adult brains get creative for a minute. Okay. The options lead the underlying market, right? Because it only makes sense that before you get into a sticky situation that you protect yourself first. Does that make sense? Okay. So I want to put on my protection, right? Before I do what? Enter a situation. Okay. So we see movement in the options before we see movement in the underlying asset. Does that make sense? Everybody on the same page with me there. Okay. I'm sure everybody could catch on to that one. Okay. I want to, oh, Gary, say it one more time, please. I want to protect myself before what? I enter into the situation. Okay. I want to put on protection before I enter the situation. Right. So if I'm using options as protection, I need to put on what? Options before I do what? Execute the situation. Okay. Now, our main thing that we want to look at, our main thing that we want to look at is our uh implied volatility. Okay. I'll use TradeStation. You can use TD Ameritrade. You can use Robinhood, Webull. It doesn't matter, but you need to find the implied volatility. The implied volatility shows up as a plus or minus number. I got the wrong. Shut my TradeStation down. Hold on 1 second. All right, everybody, can everybody see my screen now? All right, good. Okay. All right, so tomorrow is the 21st. Okay, the first thing that we want to look at is our implied volatility. This shows up as a plus or minus number. Okay, now implied volatility is telling us that based on how the options are currently priced, okay, how much up or down movement that we can expect by expiration. Okay, so tomorrow we can expect the S&P 500 settle index to move up 34 points or down 34 points. Okay, so the implied volatility already gives us a range. Okay, already gives us a range of where we can expect this move to take place tomorrow. We all on the same page there. Okay, now after that, we want to look at our last price. Okay, 52.24. Okay, so if I take 52.24 and I add 34 to it, what do I get? $52.58. Okay, so let's just say the 52.60s. And if I take 52.24 and I subtract 34 from it, what do I get? Yep, 51.90. Okay. So I got my calls on the left, meaning that the people who are looking for the market to go long. I got my puts on the right. People are looking for the market to go short. Okay. Now that I have my implied volatility range for the next trading day, the next thing that I want to pay attention to is my open interest. Okay, is my open interest. Okay, so from 52.25 all the way down to 52.60, the 52.50s have the largest open interest. Okay, from 52.25 down to 51.90. Okay, the 5200s have the largest open interest in puts. Okay, so when I'm setting up my radar screen, when I'm monitoring my options, tomorrow I'll be monitoring the 5200 puts, and I'll be monitoring the 5250 calls. Does that make sense? All right, good. So I select my same day expiration options, which are what? March 21st, which is tomorrow. I want my 7 days out. Okay. And then I want what? Something that is at least a month out. Okay. And you can look at the days to expiration. Okay. That's tomorrow. This 7 days out. Okay. And this expires in 29 days or roughly a month. Okay. So these are my three options that I'm looking for in the market. Okay. And what I'm looking for as a trade trigger, and again, I'm just going to give you the base of it, right? Is I want to see my longer dated options. So my options that are a month out, okay? I want to see them increase in price first. Okay. The same for the calls and the puts. Okay. What happens is the longer dated options premium increases before, okay, the true move of the market. Okay, so when I'm trading options, and again, we'll dive into this a little bit in the live trading rooms, is when I'm trading options, let's just say I'm trading the S&P, the SPX options, okay? But I'm trading zero DTE, I'm trading same day expiration. So these are the ones that I'm actually trading, okay? But before I enter a trade, even though these may be increasing in price, right? What's going to give me an indication that I should be buying these options, or I'm going to see an increase in price in these first? Okay. So when I see the longer dated options increase in price, I try to do what? Catch the appreciation in the shorter term expiration options. Understood? Okay. So when I'm taking a trade on the S&P 500 futures, what I'm looking for is I'm looking for an increase in the premium of the options 30 days out first. Okay. This serves as my trade triggers. Okay. So Jaleesa asks, how big of a move are you looking for in the further out options? I'm not necessarily looking for, it's not an exact number. It's not a percentage or anything of that nature. It's displayed in percentages, but I already have my analysis from what my areas of interest, my manipulation, my liquidity. All I want to see for from a confirmation standpoint is for the premiums of my longer dated options to increase in price, right? And keep in mind, I am a intraday trader, so I'm looking for the bigger move in the market. Okay. So the options serve as a great trigger for those of you who are intraday traders or who look for the big move of the day in the market. Okay. John said, why not just watch those only then? Because at the same time, John, there's still a relationship again that's literally just going to come from screen time, right? Where you can see the same day to 7 day and the weekly have a cadence to it, right? To a heartbeat or a rhythm, so to speak, right? And it's nothing that I can really um teach because it becomes a sense, right? Watching these options move in tandem. You're going to see the fake outs occur, right? In our zero DT options, the ones that's going to expire same day. Okay. Those are going to be up and down. You're going to see the volatility move like crazy, right? But uh, a week, 2 weeks of just consistently watching these, you are going to be able to pick up on the heartbeat or the rhythm of the options flow. This serves as our trade trigger, right? But again, there is a rhythm to these three options moving. Okay. And I don't just watch the 30-day out because I trade options as well. And I'm usually trading the zero DTE options. Okay. So I'm watching this price relationship to see if I even have a valid trade opportunity in that option as well. Okay. So that's why I watch all three of the options. All right, so let's get back to. Yep, it works for the S&P 500. Yes. Tony says so. I picked the same strike price based off of those implied volatility numbers and open interest only from the daily premium. Does this mean you are picking three premiums brand new each day? Uh, so I'm only picking two each day. One call, one put. Okay, but the expirations are 7 days out, 30 days out. So yes, those change as the days change for sure. John, what would I use for NQ? So, um, if I'm trading NQ and I'm looking at the SPX options, okay, I'm paying attention to the relationship of the NQ and how are the options flowing in the S&P 500, right? So, if I'm looking at the price action, and you'll find this to be true. If I'm looking at the price action of the NQ, right, the options of the S&P 500, right, typically move in tandem, especially the zero DTE and the 7-day expiration. They'll typically move in tandem with the price action of the NQ, only for the 30 to come following and lagging behind. So if I'm looking for some type of comparison or option scenario with the NQ, I'm looking at the price action or the flow of the 7-day expirations or the zero DTE expirations. Yeah, I don't look at the QQQQ. Okay. I don't like how the options flows there. But again, this is just my personal preference. If you find some validity there, uh please share it with us. But I personally uh don't care for that options chain. All right, so last thing, let's talk about the trade journal. Okay, so this is the Catla X trade journal. All of this is going to be shared with each and every one of you. Okay. Stan, and no, Stan, you don't have to start trading options. You don't even have to trade options to understand the concept. Okay. The trade journal, this is going to be shared with you all along with the recording, so you can literally track everything for you. Okay. These blue areas, okay, these blue areas are the areas that are going to be calculated, right? And this allows you to track your entry, what market you're trading, how many contracts you're trading, the price, dollar, exit amount, profit, loss, etc. Right? So let's just say one trade I made $456, another trade I made $600, another trade I made $900. And you see, right, it automatically captures your dollars, right? Total profit and loss 1956. Your average profit is $652. Okay. This area here, you get an opportunity to you put your risk to reward in here. Get to calculate your wins and losses. Okay, so you can keep track of your pertinent information, right? Lesson learned, right? Was your conviction? Did you have a low level of conviction, a medium level of conviction, right? A high level of conviction? What was your strategy, right? Was it a retest? Was it a confirmation setup? These are things that we're going to be tracking and become meticulous about in the trade room over the next month, and hopefully you all will continue to do so. Okay. Um, the second part of it, right? I'm going to be adding books, web pages in here as well. Okay, so as I come across new material or material that I want to share, I'll also be adding this to you guys' trade plan as well. Okay. And the last thing is the 48-week challenge, right? This roughly gives you a year of trading. Okay. In order to get to a destination, you have to stay on the bus. What does success look like to you? If you could pick a number you knew that you could be achieving each week from trading that would set you free, what would that number be? Okay. So this literally allows you to put that number in. So I encourage everybody to say, hey, I need to make $60,000 a year. I need to make $150,000 a year, or $250,000 a year, or whatever your personal goal is, right? It allows you to track this on a daily basis, on a weekly basis, so you can become accountable, right? For your trading. If you want to be a successful and a profitable trader, you have to stop treating it like it's a 20 or $30,000 job. If you want to make seven figures in this industry, you have to be precise. You have to put a you have to put a date on it. You have to put a dollar amount in there, and you have to understand exactly what you're after, right? And again, this is what I mean by falling in love with the process of it, right? Because if you have a foundation and you have a process, you can clearly see you're going to make some mistakes. There's going to be some hurdles. There's going to be some pitfalls, right? But there's no need for you to be discouraged about continuing on the journey, because you know exactly where you are falling short. Hey, my risk to reward number isn't where it needs to be, right? My profitability isn't where it needs to be. My win to loss ratio isn't where it needs to be, right? I haven't, done the proper things. I can easily identify the things that I need to do in order to get to where I need to be, right? We all on the same page there. Okay. So obviously we're going to be together close quarters um for the next month. And this is something that we're going to be tracking, and I'm constantly going to be updating and encouraging you all to do and posting inside of the CalaX VIP group as well, because once the CalaX VIP trade room commences, this is what we will be following. This is our blueprint. This is what is going to hold us accountable. Yes, it's not exciting. It may seem boring, but when I tell you, this is the absolutely most important part of trading, and especially doing it on a consistent basis, right? Everybody here has experienced winning trades. Everybody here has experienced winning days. Some of you all have passed evaluations, but how can you maintain that consistency 6 months from now, 12 months from now, 5 years from now, 10 years from now? And it absolutely boils down to becoming committed to the process, being accountable, and understanding your strengths and weaknesses when it comes to trading. Okay. All right. Well, listen, that is the end of our foundational boot camp, day 1 and day 2. I'm gonna open up the floor for a few minutes to answer some questions. Um, I'm gonna drop the recording. You all should get the recordings by tomorrow. Yesterday's recording is already ready. This video has to render. I want to deliver both of the videos at the same time to you all. Those of you in the boot camp, we will be sharing the CalaX Trade Journal with you as well. And next week we'll have our first live trading session, and we'll continue to have live trading sessions that will be inclusive of everybody in the boot camp for the next month. Every day that I trade, we will have a live trade room. You guys will get a link for it. The days that I'm not personally trading, we won't have a trade room. Okay. But every day that I'll be trading personally, you all will have access to it. We'll be diving into these things in real time. And also on my trading days, you all will receive a copy of my trading plan with my key levels, key zones, my points of interest, and different things of that nature before we even come to the market. So that way, everybody is always already prepared. If you have questions about, hey, Chris, where did you get this level from? Why that level, etc., everybody can come properly prepared. We can hold each other accountable, and we can enjoy this journey to the top together. All right. So I appreciate each and every one of you all. I appreciate you all for investing in yourself, believing in me, believing in yourself, and just taking on this task of this journey that can definitely prove to be life-changing if you just simply commit to the process. All right, so if you have a question, I'm going to open up the floor for a few minutes and bring you up on the mic, and we'll go from there. Stan, you got the mic.
Yes, sir. Real quick question. When it comes to marking liquidity,
Mhm.
it looks like you marked the bottom of the doji. When we're talking about marking the doji, do we only mark the bottom of the doji and no other part of the doji?
So we marked the bottom of the doji on the up move, and we marked the top of the doji on the down move.
Got it.
Yep.
All right, thanks.
Yep, no problem. All right, who else? Al, you got the mic.
Hey, what's up? You can hear me?
Yep, I can hear you.
All right, so I got a question about the Cadillac X, the MMA and X3. What's the difference between both of those?
So the Cadillac X3 is manual, and the MMA is for automated execution.
Okay, so the one with the two blue lines, that's the X3.
Yep, the two blue lines, that's the X3.
Okay, and the MMA on the chart, what does that one look like?
It'll have some pink signals, but we're only going to be using the Cadillac X3 in the trade room, and that's the only thing that I'm going to be posting about is this one here, the Cadillac X3.
All right, so the thing is when I put the X3, I think you probably modified yours because they're both blue. Mine's is like one is red and one is green. Does that really make a difference, or is just the zone in between the lines?
No, it's just the zone in between the lines, and if you if you refresh it or take it off and put it back on, the update should automatically update for yours.
All right, cool. Thank you.
Yusuf, you got the mic.
What's up, General? How you doing?
Good. How you?
I'm blessed. Thank you for all of this, bro. It's amazing what you do.
I
First
appreciate it.
off, no stress. My question is in regards to the order blocks or the high concentration zones. Do I notice you don't really treat them like FUs, meaning usually in FU when we go and retest and it reverses, sometimes we eliminate that zone completely because it's as if it was used already.
Yeah.
Is that the same way you're gonna use a high concentration zone or an order block? And another question to that as well is, do you ever use them for continuation? Meaning, if you see price action goes through, you wait for another FU to continue bias. So let's say reverses and goes back up. Would you take that trade, or would you just not eliminate the zone completely?
Yep. So no, I definitely wouldn't eliminate the zone, right? But it's all dependent on how price reacts from that zone, right? So for example, let's look at this, let's look at the 1 hour on gold, right? So this our last green candle, and it followed by FU to the downside. You see this right here?
Yeah.
Okay. So this would be a highly concentrated manipulation zone, right? So I'll do what? Block out this order block here and
Yeah.
drag it across the screen here, right? So let's see what type of price action we got on our execution time frame from it.
I tried this today and actually like got me out of my slump from last week, man. Respect for that, bro.
Nice. So look, this is the zone here, right? We had a rejection here, and we formed a FU to the upside.
Yeah.
Right above the zone. Right. So and we had relevant liquidity here. This FU to the upside definitely would have gave us confirmation to continue long. So understand this about the institutional zones, the order blocks plus the FU. They're two-sided. Okay. So if the market was to if the market was to you know, come up to this zone, I might be initially expecting a retracement down, especially if I have manipulation to the downside on a higher time frame, right?
Right.
Okay. But again, we know the market can do anything it want to do at any given time. What if the market decided to just break through this zone? If the market came and broke through this zone, this is still a highly concentrated manipulation area. This is still where the banks and the institutions participated, right? So I would look for some type of retest here and a rejection. If I got rejection and manipulation to the upside, then yes, this would be a valid trade entry long in the market. Okay.
Perfect.
Yep.
And what about FUs? Like an FU zone on a higher time frame, that you would eliminate if price action went through it, right? Or would it be the same?
So if a just a regular FU is, if a regular FU is broken, right? What I typically would do, let's see if I can find
Or
one.
even if it's just retested with a FU going down, would you eliminate that zone? Because that's what I was under the assumption we used to do.
Yeah,
But
so with these highly concentrated manipulation zones, I rarely eliminate a zone unless the market no longer continues to test them. But as long as I'm getting a rejection from this zone in some shape, form, or fashion, it remains valid.
I noticed sometimes like that last example, the price went through it, it came back down, and then an FU went like it came back through it completely.
Yeah.
That would it doesn't necessarily have to stop in the zone as long as it's like there's a manipulation somewhere around it, then you go for it, right?
Yes, because that FU through that zone on the 5 minute,
Yeah,
we know that a FU to the upside is also what, manipulation.
that's right. Yeah. I appreciate it, bro. Thank you very much, man.
Yep, no problem. Pleasure all mine. Misha, you got the mic.
Good evening.
Good evening.
So I had a question about attempted FUs in the form of dojis.
Okay.
When developing my trade plan, I just get like hung up on whether I need to consider as a target or whether I need to consider as a zone for possible entry.
Okay,
So like, how do I weigh those two things against one another?
okay, so the attempted FU is always the weakest form of manipulation. Okay, it's always the weakest form of manipulation. So it as a doji, right? It could be a let's just say it could be a target, right? Or it could serve as a as a retest or a rejection zone. Okay. So what I typically do, let me see if I can find a good one. All right, so we're looking at the 1 hour time frame. Let me see what it looks like for. All right, so this we can go down to the 1 hour. This a FU to the downside in the form of a doji, right? This is what you would consider it to be, right?
Right.
Okay. So in this instance, I understand that the attempted FU is the weakest form of manipulation, right? But it isn't to say that it won't hold, that it's not valid, that the market can't retest or form a high confirmation. Okay. What I simply do is I'll take this wick, I'll take the wick of the doji, right? And I'll just outline the zone. Clear this one out for some stuff so we can have a clear picture. Okay, and what I'll do is I'll start nailing down what it looks like on my lower time frames.
Okay.
Okay. This isn't something I would consider necessarily consider a FU to the downside. Let's look at the 15-minute. 15-minute, we definitely don't have any type of manipulation here, right?
Right.
30-minute, we don't have any type of manipulation there. Let's look at the 5-minute. And look, the 5-minute is filled with what? Dojis,
Mm-hmm.
right? So it's a high probability that that 1 hour FU would not hold, right? Because look, we got a perfect double top in the form of dojis here. We nail it down to our 5-minute time frame. So I say all of this to
Okay.
say is if you're unsure about an area, right, especially on a higher time frame, just mark out the area you're unsure about and start zooming down in your time frames to unpack what's going on in that area.
Okay, perfect. Thank you so much.
Yep, no problem. Does that make sense, everybody? Good, good. Jaleesa, you got the mic.
Can you hear me?
Yep, I can hear you.
Appreciate it.
Yep,
When you're marking your levels, like at what time, like let's assume we're getting ready for the morning. What
yep.
time do you go in and start to mark your liquidity levels and like kind of set yourself up for the day?
So I typically do it before I go to bed at night, right? So whatever time before I'm getting ready to go to sleep, I usually do it before I go to sleep. And then before I come to the market, right, before I actually start trading, I'll go back and I'll see if any new zones have been formed, uh, from the time I marked them before I went to bed until right before I get ready to trade. Right. So if I need to make any adjustments or add any new zones, I'll do that right before I start trading in the morning. But I typically mark up everything before I go to bed at night because I already have it's already going to kind of give me a clear picture of what I'm likely to expect in the market the following day.
Okay.
Make sense?
Yep.
All right,
Thanks.
good. All right, well, listen, it's 9:24. Again, I appreciate you all's time, patience, and commitment. I look forward to working with you all very closely over this next month and beyond. Everybody has the foundation from the technical side of things, the planning side of things. And my expectations is for all of us to work in unison, collaborate, find you a partner or two, or inside of this boot camp group, because we're all working from the same foundation, the same level, same understanding, and let's help each other max out our potential when it comes to this trading thing. So I appreciate your time, and I look forward to working with you all. And next week we get to rocking and rolling. All right, I'll have a video. The video should be to you all tomorrow, as well as the trade plan being shared with you all tomorrow. And anything else, we'll be updating you along the way. All right, you all enjoy your night, and I'll see you all later. All right, peace.